you're a home buyer, somebody or a young person looking to buy a home, you need a bit of a reset.
There is a possibility on the other side of this that inflation could actually be quite
Y'all,
low.
this is absolutely bonkers. We got over 2 million homeowners right now that are over 30-day late on their mortgage. And a big problem with that, guys, is when you're 30 days late on a mortgage, you've absolutely destroyed your purchasing power and your credit. So a lot of these homeowners that feel like they're going to avoid foreclosure or not have to sell their house, those people no longer have purchasing power. And another shocking thing right now, you guys, both VA and FHA have delinquencies near GFC levels right now. And I was blown away. And I'm going to show you guys what's happening with VA loans right now is absolutely shocking and absolutely scary, because remember, people shouldn't be going into foreclosure right now because home values at worst are sideways. Well, okay, let me take that back. If someone purchased prior to 2022, which is most people, if you purchased prior to 2022, you shouldn't be going into foreclosure. You shouldn't be late on your mortgage, but that's exactly what we're seeing. We're seeing people default and go into delinquencies at 2, 3, 4, and 5% interest rates. And so today I'm going to go over all of the most recent foreclosure data. We'll take a look at the savings rate. We'll take a look at credit cards, auto loans, and school loans, and see and get an overall picture for the health of the homeowner. And if you guys find value in this video, please like it, share it, shoot some comments below, and understand I appreciate you very much. Actually, the last video I made was titled "Foreclosures Are Going to Skyrocket in 2 weeks." Now, the only problem with that is I can't even see that data until the end of January, because my point is the end of November of 2023, the foreclosure moratorium for the lockdowns is over. And there was over 350,000 homeowners that were protected against foreclosure. Again, you guys, that's over, except with VA loans. That moratorium has been extended. So this is going to be Black Knight's first look at November mortgage performance. Delinquencies still historically low despite seasonal rise. I like how they put seasonal rise, because that's what it has to be, right? It can't be unaffordability. It can't be the job market. It can't be the economy. It has to be seasonal. Performance of recent originations worth watching. Now, there are some solid bullet points right here, you guys. I'll read all of them. The national delinquency rate edged up higher to 3.39% in November, down 10 basis points from the same time last year, but remains 64 basis points below pre-pandemic levels. So less than 1%. That's basically 0.64%. Now, this is the shocking one. Listen to this, guys. Likewise, early stage delinquencies among VA loans hit their highest non-pandemic levels since, holy moly, since 2009. Since 2009, we have the delinquencies at the rate of 2009. That's the GFC for VA loans. And also FHA loans are right behind VA. How shocking is that? I mean, why aren't we hearing this in the news? Is that not shocking? Let's move on. Serious delinquencies, 90 days plus past due, rose. That's the bad one. That's like, I'm going to lose my house. I'm going to try to take advantage of every program. 90 days late is very, very bad. Your credit is done. Your purchasing power is done for a very long time. That rose to 459,000, but down 123,000 from November of 2022. Not sure why they're saying November, not year over year, but it is what it is. Now, foreclosure starts decreased 12.9% in December to 29,000, with active foreclosure inventory falling to 216,000. So they have 216,000 homes in foreclosure. So let's take a look at the foreclosure chart line by line. You guys can basically see right here that we have a lot of things down, but a lot of things up as well. Really, the only thing that's down of any significance is total foreclosure starts. So that's down month over month, 12.9%. But what they failed to mention when we just read that bullet point is even though that's down month over month, it's up year over year at 6.7%. So foreclosure starts are surging, even though it is down month over month. Again, 29,000 more homes now starting the foreclosure process. But again, starting at the delinquencies sitting at 3.39%, that's up month over month, as you can see at 3.95%, but down year over year. Now, foreclosure pre-sale inventory is slightly down month over month, but it is down pretty significantly year over year at 8.18%, sitting at 0.41%. That's very, very low. Now, total US foreclosure sales is both up month over month and year over year, sitting at 6,500. So 6,500 homes were sold as foreclosures. Now, this next set of data is very, very mixed, very, very interesting. Almost everything is up on a month over month basis, but down on a year over year basis, which is very intriguing again. Now, the number of properties that are 30 days or more past due increased month over month. So 70,000 more American households are now behind on their mortgage and have just destroyed their credit and purchasing power. The total is now 1.8 million. So we got 1.8 million households that are not making their mortgage payment right now. Okay, that just started. Okay, so they're not in foreclosure yet, but they are in danger of foreclosure. That is down though year over year by 24,000. It seems like it's been at 1.8 for a very, very long time. It's going to be interesting to see this start changing. Now, the total number of properties that are 90 days past due, these are the guys that are like knocking on the door of foreclosure. That's 459,000. That is up 12,000 month over month, but down a whopping, this is a huge number, down 123,000 year over year. So maybe that, again, was part of the moratorium. They kicked them out. Now they could be back in the 30 days or more past due, or they could be in loss mitigation. So this 123,000 people, that's probably loss mitigation. They're probably still paying something and probably not caught up. Time will tell. Now, as far as homes that are in foreclosure, again, that's 216,000 total number of households in distress, whether it's in foreclosure or whether they're behind on 30 days, 60 days, is over 2 million households. That has gone up month over month of 69,000. So 69,000 households join this list. It is down, however, year over year, 39,000 households year over year. Very interesting here, guys. The top 5 states for non-current percentage. This is actually going up pretty significantly. Number 1 is Mississippi. Usual suspects here. Louisiana, number 2, Alabama, pretty surprised. Indiana, Arkansas. But leading the way is Mississippi at a non-current rate of 8.1%. Now that sounds high, right? I mean, it is high. That's 8% of mortgages in the whole state of Mississippi that are down. That is high. But when we look at the peak, it actually peaked in October of 2005 at 23%. So 1 out of 4 people in Mississippi in 2005 were behind on their mortgage. That's freaking bonkers, isn't it? Comment below. Seriously, do you think 23%, peak in delinquency rate is a lot? I do. But look at Louisiana. Louisiana's number 2 at 7.75. Again, that's high, right? But look at the peak, you guys. The peak, again, October 2005, 30.6%. That's about 1/3 of people with a mortgage behind. So we don't have the foreclosure crisis or the delinquency crisis like we did during the GFC. But the thing is, guys, we're not in recession. Things didn't get real bad during the GFC until the recession started. And when it started, things absolutely blew up. It skyrocketed essentially what felt like overnight. It was a period of about 2 to 3 years, but it felt like overnight because the data absolutely skyrocketed. It broke all trends. Now take a look at this, guys. Here's the bottom 5 states for non-current percentage. California, number 5 at 2.24%. Again, I mean, I don't see how that could be, the bottom like that when it's one of the most unaffordable places. In fact, all of these are like West Coast. So maybe this data is tainted because the moratorium or loss mitigation, but it seems tainted to me. The number 1 leading metro, though, is Colorado, sitting at only 1.99%. It's interesting to note that Colorado's peak is where Mississippi's at right now. So the peak in Colorado was 8.6%, but not in 2005. That peak actually hit February of 2010. Very interesting to see how much different some of these metros are. And I'm going to tell you guys right now, when we go into recession and we have any type of unemployment phenomena like we did during the GFC, everything's going to come crashing down because everything's built on a house of cards. And not only is it built on a house of cards, like we don't really have excess savings, like people are really struggling, even though they say inflation is going down and the economy and the job market's good, but that's not true. When we start recession, it will come crashing down because the fact of the matter is most Americans right now are out of savings and drowning in credit card debt. We see that in the numbers. Let me show you. Starting with potentially the most important thing, people's ability to save. You guys, it is so low right now. The only time it's generally this low is right before we enter recession. Except in the 70s and 80s, people were able to save like crazy, but the savings rate right now is only 4.1%. Pre-lockdowns, you guys, we were at sevens. Look at this. January, 7.2, February of 2020, 7.7. Prior to that, staying in the low sevens. You see that? Sometimes in the eights. I mean, you guys, we got more money printing than we've ever had, but yet we can't save any money. The reason is inflation is still really bad. We haven't had the bust part of the economy yet. Yeah, we've had the boom, but we're still waiting on the bust. And that's going to be interesting to see what happens in 2024, being it's an election year. But make no mistake, people are drowning in credit card debt. And we see that right here by taking a look at the total amount of consumer credit card debt, which is over $1 trillion. We're sitting at $1.02 trillion. And the astonishing thing is the trajectory, because remember, right here, people were paying off their debt. Look at this. So we got printed money. People are like, okay, I can't do anything, so let me do the responsible thing and pay off my debt because we can't go outside and do fun things. But as soon as it lifted, look at this. People spent all of their money and just kept spending instead of like what I'm trying to do, which is not spend and save my money to prepare for recession and downturn. But people aren't doing that. And I've heard people say, well, this is just, people pay this off as soon as it bills. I don't. Okay. I spend on my credit card to get cash back. I have a Wells Fargo active cash credit card that gives me 2% back. So that's my main purchases. And then anytime I buy things on Amazon, I have 5% cash back. But I'm one of the people that pays my credit card before it bills. You could pay it after it bills to avoid finance charges as well. But based on data from the CFPB, most of the people that are letting their credit card balance bill are not paying the balance off in full, like we've heard from certain people. Again, most people are not paying the entire credit card balances off. They're staying stuck and trapped to that credit card debt. And if that wasn't bad, guys, take a listen to this. Nearly 9 million borrowers have missed their first student loan payment. We have so much going on right now. It is a house of cards. If we had a great economy, a great labor market, then 9 million borrowers would not have missed their student loan. That means roughly 40% of the 22 million borrowers who had bills due did not make payments. That's insane. 40%, you guys. How's that possible? Being that our labor market and economy is so great, how is 40% of people not making their bill payments for school loans? I mean, think about it. Comment below. How's that possible if we have a strong economy and a strong labor market? How's that possible? But that's not all, you guys. Delinquency rates for car loans, okay, are higher now than the GFC. Okay, so they're highest levels in almost 3 decades and almost 30 years. And credit card delinquencies rates climbed to a decade high, and that's from the Fed. This is a recent article. Y'all, the economy's not okay. I don't understand why some people don't get that. And I'm going to tell y'all right now what happened during the GFC. All right, people like stated income, stated asset, blah, 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 blah. People stopped making their bill payments. And when people stop making their bill payments, the financing sector, the banking sector melts down and crashes. And that's exactly how it's going to work this time. We see it already in the data. When consumers stop making payments, everything falls apart. Now, as far as when we're going to see the effects of the foreclosure moratoriums ending at the end of November, I should be able to access that report at the end of this month in January. But either way, I hope you guys gained some new insights, value, and perspective. I hope this video helped as to what's really going on behind the scenes. And if you're out there investing in real estate, you guys already know I wish you luck, and I hope you win.